Hello and welcome to Russell Investments Market Week in Review for the week ending April 14th, 2023. I'm Zoe Wargans. I'll be your host today, and I'm joined by our Chief Investment Strategist, Eric Ristopin.
Hi,
Eric?
Zoe.
Hi, thanks for joining us today.
You bet.
Thrilled to have you here. Can we kick things off with CPI?
Yeah. Well, obviously, inflation, number one issue. We got a release this week. Core CPI is more of a problem than the headline CPI. Headline CPI month on month was up like 0.1%. Core CPI up 0.4%. Year on year, I think it's 5% for CPI and 5.4 for core CPI. Remember, the Fed's target's 2. So that's
right.
That's it. But you get some insight as to what's going on with inflation, and we've been saying this for a while, but we reaffirmed again in this drop. Things aren't the source of inflation anymore, right? When we first started our inflationary problem, that's where we're getting the inflation.
Right.
Where we're getting the inflation now is in the stickier categories, namely services and shelter. The shelter's not that worrisome. Because if you look, there's been months now where the new rents are actually a little bit higher than the old rents, and in some cases they're actually lower. So that's just a time thing, right? Eventually, right. You'll be dividing, the current number by a number that was much closer to it because they didn't go up very much month on month on month.
Right.
So we're pretty confident that one's kind of a self-correcting thing. The one that isn't self-correcting is the services side, and that's because those are wage intense. Parts of the economy, and we still have wage pressure in the U.S. economy. The latest Atlanta wage tracker for March was 6.4%. That's way above the 2%. There's other indications that you're seeing wages begin to mitigate in terms of the rate at which they're going up. But if you look at the jobs numbers, right, we created 1 million jobs in the first quarter.
Yeah.
I mean, that's a lot of jobs for an economy that was arguably already at full employment at 3.6%. So unemployment rate dropped 3.5%. If you look at that hiring, almost all of it is in the services category, right? Or most of it. So the growth is in the services. It's in restaurants. There's probably a good reason to expect that a lot of that's catch-up hiring, where these people weren't able to hire because the big firms were hiring so rampantly. So that probably will begin to peter out. But until we take some of the heat out of the labor market, we're probably not going to see the progress in the inflation that we have. So you put that all together, and it doesn't change the picture a whole lot in terms of market expectations, right? They're still, the market's still expecting the Fed to be treating inflation as enemy number 1,
Absolutely.
Recession enemy number 2.
Speaking of the Fed, how are Fed rates coming along with this new information?
Well, we're still expecting a 25 basis point rise. We saw Fed minutes were released this week from the last meeting, where they tell you what they talked about, basically. It kind of an interesting read. Well, there's sometimes an interesting, sometimes not. This one was kind of interesting because the staff clearly felt that with the banking turmoil as yet another potential headwind for the economy, that a recession was likely to start at the end of this year, 2023. Right. And yet, the committee still voted to raise interest rates. So, I've been saying personally for a very long time that people have to change their views as what a Fed mistake is, right? Most people have been conditioned over the last 30 years, myself included, right? Because we haven't had inflation since basically, before my career started. I've been in the industry 40 years, and that was, inflation was a problem before that. So this idea that, the Fed mistake is a recession, that is normally the case. It's not the case now, right? They view not killing inflation as the mistake. They've said it countless times, they're willing to subject themselves to the U.S. economy to a recession if they can that'll help them get inflation under control. Right. Their staff said they expected inflation, they still raised rates. I think that's a pretty good indication that they're very committed to killing off inflation. Yeah. And we didn't see anything in the numbers that it changed our expectation that they would raise again in early May. Whether they need to, arguable, probably not, but I think they do want to send the message to the market that they're serious about inflation.
That certainly seems clear, given what we've been hearing. Yeah. All right, then let's wrap this up with earnings.
Yeah. Well, we've talked a lot about a lot of macro stuff, a lot of monetary policy, and more than I want to talk about ever. But inflation. But I think the market focus is now going to be at least split a little between those big macro issues and some of the more micro, and that's earnings.
Yeah.
Earnings estimates for the S&P 500 growth for the first quarter of this year are expected to be minus 6.8%. So, we're going to start seeing earnings, begin to deteriorate according to analysts' expectations. It is interesting to note that at the end of December, when you asked them what they thought the expectation was for the first quarter, it was minus 0.3%. So during the quarter, their expectations have gotten lower and lower and lower, and even recently they've gotten lower. So I think the reality is, got Mike Wilson at Morgan Stanley saying that he expects a earnings recession. So I think this is going to be a really interesting couple of weeks because, we don't expect a lot of strength out of earnings in the U.S., the S&P 500, but it will be interesting to see is it going to be as bad as expected? Because I think that might tell us a little bit more about what might be the path for the stock market for the next few months. Probably not for the entire year, but for the next few months. So I think earnings is going to be important because I think it's going to be a pretty big issue for 2023. Analysts do expect balance 2023 to have positive earnings of about 1.2%. But, that's a weak front end and a strong back end. And sometimes those strong back ends, if the Fed staff is right, recession, you're probably not getting a super strong back end earnings growth. So let's see how this all plays out. But we're going to start actually seeing real numbers here pretty much starting next week.
Great. Okay, that's interesting. Thank you for that big picture take on things there, Eric. And as always, thank you so much for joining us. Your insights are second to none. And thanks to all of you for joining us for another Market Week in Review. Please tune in next week.
Hi, I'm Eric Risteman, Chief Investment Strategist for Russell Investments. If you like what you saw in this video and want to see more like it, please subscribe to our YouTube channel.